Oil prices continue to fall. Even the reduction of crude oil reserves in the United States by almost 7 million barrels had no effect. We can try to attribute this decline to yesterday's strengthening of the US dollar, but oil ignored its weakness the day before. The so-called thin market is most likely the reason for it. Large investors have gone on Christmas vacation and will likely return to the market after the new year. Against this backdrop, even a small trading volume can move the market significantly. Notably, this is exactly what is happening. Moreover, there is a growing confidence among market participants about the worsening of the global economic outlook and the resulting decline in energy demand. Today, the market is likely to consolidate around the current levels, mainly due to the early closing of the oil stock exchanges. The Brent crude oil futures lost about 3% on Thursday, and this significant change in the prices caused a speculative jump, with the quotes almost reaching $77 per barrel. In the current situation, the crude is oversold in the short term, accompanied by reduced sales volumes. If the prices do not go below $77, oil may recover slightly. Gold followed the currency market. 2 days ago, the US dollar fell and gold rose. And yesterday, the exact opposite happening by and large. Gold returned to the levels it was at before rumors of a March rate cut by the Fed. In any case, the precious metal remains close to the year's highs, aiming to hit the $2,100 level. Given the growing fears of a global economic recession and the impending easing of a monetary policy by major central banks, gold could breach this level early next year. Contrary to our forecast yesterday, the Russian currency showed surprising growth at one point, reaching 88 rubles per dollar, and this is most likely due to both the upcoming release of inflation data and thin market conditions. Before the publication of inflation data in Russia, speculation was inevitable, but it was precisely because of the small volumes that they could lead to such significant movements. According to forecasts, the consumer price growth rate should accelerate to 7.9% from 7.5%. The Central Bank of Russia will continue to raise interest rates, which causes resentment among businesses and investors. The regulator does not hide the fact that the ultra-tight monetary policy harms the economy. Nevertheless, it continues to raise interest rates. Analysts expect that the growth of inflation will lead to the weakening of the ruble, and the data will be released after the market closes. The data may be offset on January 3, when the first rates on the ruble in 2024 will open. That's all for now. We wish you profitable deals. See you on our channel with a new video in a couple of hours.